We are seeing some selling pressure in Toronto again today, with the benchmark off more than 150 points. In addition, we're seeing some weakness in New York for the S&P 500. The American benchmark is on pace for its largest two-week slump since mid-October. Some asking if the move is now testing how much longer the bull market can run. Hotter than expected inflation in the U.S. has been one of the catalysts curtailing stock gains. Meanwhile, earnings season, which kicks off officially tomorrow, could also have an influence on performance. Bob Iaccino is co-founder and chief market strategist at Path Trading Partners, and he joins us now. Bob, nice to see you. What do you make of what's going on in the market right now?
Well, I mean, inflation is the whole story, right, John? I mean, you look at what came out yesterday, and it wasn't just that it beat, it was how thoroughly those numbers were higher and what was higher. The only real outlier we saw was motor vehicle insurance, which was up 2.8%. Everything else was either flat, slightly down, or a decent amount higher, so it was broad-based. Number two, the Fed's supercore is now up 4.8% a year. I mean, the supercore is ex food and energy minus shelter, and that was supposed to be what was going down. You add to that what's going on with services inflation, whether you're looking at the last read, 3-month annualized, 6-month annualized, you're in excess of 5 to 6%, depending on which of those measures you're looking at. And then you go to commodities. We all see what's happening with copper. We all see where crude oil is stabilized now in the mid to high 80s. That's not going to help. So things are not looking good for the prospect of a rate cut, yet I think we're still going to get the rate cut. I think this is something the Fed wants to achieve before year end, at least in the first quarter of 2025. So I think we're going to see one. And, you know, as a strategist, John, it's my job to figure out what's going to happen and what effects that's going to have, not what they should do or why they should do it. I don't think the Fed should cut rates, but I think they're going to.
And I guess, what about the fact that the market itself had just had this huge run? I was just calculating the S&P 500 performance from the fall lows into the recent highs. It was a gain of upwards of 28%. We have come down, call it 2% from the peak. Nothing. So it's pretty puny. But I guess, you know, does that matter as much as the fact that, you know, we're trying to figure out levels of inflation here and what that means for Fed policy?
Well, what it means to me is that we shouldn't worry. Even if we've seen the highs for 2024, which I'm not sure that's the case, but even if we've seen the highs for 2024, as long as we don't completely collapse, you still got a pretty decent year on your hands in terms of returns. I have us staying in a bull trend unless we drop more than 12%. So that 2% you just mentioned, you know, it's like throwing a lawn chair off the Queen Mary. It's nothing. I mean, it's nothing to worry about at this point. And I don't think stocks or really assets in general should worry, because if I'm right that inflation is not just slowing down its path to 2%, but reversing it back up to closer to 4 to 5%, that's good for assets. We always forget that within inflation, there's asset inflation, and that includes stocks, it includes real estate, it includes things like gold, and to a certain degree, Bitcoin, although I don't think that's proven out over a long enough period of time. So when we're looking at assets like stocks, even if we get a pullback here, I honestly would welcome it and would probably buy that dip. This, to me, isn't even a dip.
Let's talk about technology stocks. They've gotten a lot of attention this year. Those are the names that have had huge moves. Everybody's now watching Google's parent Alphabet, which is seeing its market valuation head towards $2 trillion. AI this, AI that. It's captured the market's attention. After a run-up like the one we've seen in stocks such as Alphabet, maybe doesn't get as much attention as NVIDIA or Microsoft. What do you think about its prospects?
I like Alphabet a lot. I have it in two baskets of things we look at. In our shorter term basket, trades that we look at generally has a hold time of about 26 days. And I like it there for a move closer to about $170 from where it is right now. And then even if it doesn't do that, I tend not to mix these two. So if I buy something in the short-term basket and it goes against me, I don't all of a sudden say it's a long-term trade. That's a cop-out. But from a longer-term perspective, Google still has a very large and almost insurmountable competitive advantage in search. And, you know, while they missed on revenue from their online advertising revenue in their last report. They just have to clean that up a little bit. The entire market is changing there, and Google's always been at the forefront of it, so I think they'll do a decent job on that.
Let's shift from technology to retail, where Walmart has been a stock this year that has easily outpaced the Dow itself. This is a stock that has been a constant winner through recessionary periods, but I think what we have seen is the recession worries pushed off a little bit in the United States. So how do you think about a stock like Walmart at this point of the game?
So I almost get tired of saying how much I love Walmart. It all started for me about 5-6 years ago when I started actually comparing Walmart's online prices to Amazon's. And probably this is anecdotal and I'm kind of pulling it out of the air, but about 65-70% of the time, Walmart was cheaper. And if you could wait an extra day for it, you can take advantage of those savings. Their online business is growing. It's not going to overtake Amazon, but it's growing. And I really like the new Vizio deal. They're buying Vizio, and it's going to be able to help them reach customers directly for their Walmart Connect business, which is an advertising platform, for lack of any better way to describe it. And it's going to have a huge effect because Vizio, while it used to be seen as sort of a subpar platform, isn't that anymore in terms of their displays. They're very high quality, and I think this is a really, really good stock to get into. But I want to get in on a little bit of a pullback. I see at least 10% in this stock from about the $60 range, so 66, 67 is easy. And then if we have this inflationary cycle, people look for those lower prices, and they tend to be at Walmart.
Both of those stocks we've talked about, Alphabet and Walmart, have a majority of buy ratings from Wall Street analysts, as does Western Digital, which is a data storage play. It's had a big run. What is it you like about the business?
So I started to notice WDC when a hedge fund, and I'll leave their name out, but because it was in a report, said that they needed to split off their hard disk drive business and their solid state drive business to unlock more value. They committed to doing that, and the value showed up. And now the chart looks really good. I really, really like the chart on this. 72% buy rate on this particular one, up from 67% last quarter. And they made that commitment to split HDD and SSD. And I just think the chart looks really, really strong on this. This is data storage. And while a lot of that's going to the cloud, some of it is still going to exist in actual physical materials, physical drives, a big portion of it actually. So this, I think, is a company that can also be a longer term hold, but I like it for a buy of around 90, again, looking for somewhere in this 10 to 12% return over, say, the next 18 months.
Bob, good.